Most CTA factor research is a fishing expedition. You write code, run backtests, and pull out signals that look promising, but they are often just noise. The real problem isn't the code, it's the lack of a framework. Without a structured approach, you're not finding signals, you're overfitting to random patterns. In this episode, we break down the complete CTA factor research framework, feature classification, fundamental factors, data cleaning, and validation. By the end, you'll know why framework beats code and how to avoid the most common pitfalls that lead to false discoveries. When you start a CTA project, the temptation is to compute every indicator you can and run a backtest. But that's a lottery. You need to answer 3 questions first. Is this factor cross-sectional, meaning it applies across all commodities, or is it time series, specific to one commodity? What is the underlying logic, quantitative, fundamental, or positioning? And have you cleaned the data so that noise isn't mistaken for signal? Without a framework, you're exploring without a map. You might occasionally find gold, but more often you'll come back empty-handed. Features fall into 2 broad categories. Universal features, like volatility or basis, work across all futures. You can calculate volatility for any commodity at a given time and test its correlation with future returns. That's cross-sectional. Basis, the difference between spot and futures prices, also applies everywhere. But some features are limited. Northbound capital flows only matter for stock index futures. Commodity positioning data covers most commodities but not stock index futures. On the other hand, specific features, like port inventories for iron or housing starts for rebar, are more granular and can uncover signals others miss. The key is to know whether your factor is universal or specific, because that determines which features you should use. Futures don't have earnings reports. Fundamental factors must come from the supply chain. For the Black Series, the upstream is coal and electricity, the midstream is coke and rebar, and the downstream is autos and machinery. You can quantify factors like coking coal operating rates, rebar inventories, and year-over-year changes in car production. But inventory data comes in different forms: port, mill, and social inventories. Port inventories are volatile and short-cycle, reflecting immediate supply-demand imbalances. Mill inventories are smoother and longer cycle, reflecting production pace. You need to know which inventory measure is the core indicator for your commodity. The research dimensions are supply, demand, inventory, and spreads. Supply includes production costs, operating rates, and imports. Demand includes downstream operating rates and apparent consumption. Inventory is the most complex, and spreads and margins are calculated from price differences. The quality of your fundamental data determines whether your factor can work. First, publication frequency. If you only have monthly data, your factor can only rebalance monthly, but futures markets move quickly. Weekly data is better, and daily data is ideal. Second, stability. Some data sources are unreliable. For example, nickel ore data often comes from Indonesia and can be delayed by a month or 2, or even discontinued. You don't know if it reflects current conditions or conditions from 2 months ago. Third, timeliness. If Indonesia changes its export policy, the pricing logic for nickel changes. If your data is pre-policy, your factor is dead. Fourth, history. You need at least 5 years of data, covering a full industry cycle, otherwise your backtest might only cover a one-sided market, leading to severe overfitting. This chart illustrates the impact of data frequency. The blue line is weekly data, which is volatile and captures key turning points. For example, in March, operating rates suddenly dropped, and in May, they rebounded sharply. The red line is monthly data, which smooths out all these details, showing a gentle curve. If you use monthly data, you'll never know what happened in March, and your signals will be severely delayed. So, when building fundamental factors, prioritize higher frequency data. Even if the coverage is narrower, the information value is much greater than low frequency but comprehensive data. Before using any time series feature, you must check if it's stationary. A stationary series has constant statistical properties over time. If it's non-stationary, like iron or production which trends upward, correlations you compute are likely spurious. The augmented Dickey-Fuller test, or ADF, tests for a unit root. The null hypothesis is that the series has a unit root, meaning it's non-stationary. If the p-value is less than 0.05, you reject the null and conclude the series is stationary. If the p-value is above 0.05, the series is non-stationary, and you need to transform it. If a feature is non-stationary, you have two common treatments. First differencing, subtract yesterday's value from today's to remove the trend. Second, detrending, divide the current value by a rolling mean over a past window to get a relative change. Only after stationarizing can the feature be used for factor research. For example, iron ore production has a p-value of 0.63, clearly non-stationary. Railway freight volume has a p-value of 0.89, also non-stationary. Power generation is 0.06, close to the threshold, so it needs cautious handling. The BDI index has a p-value of 0.02, so it's stationary. Rebar inventory year-over-year and PDA processing margins have p-values of 0.15 and 0.24, respectively, so they are non-stationary. Always run an ADF test before building factors. If you skip this, your IC and ICR calculations will be meaningless. Futures contracts expire, so you can't just stitch together prices from different contracts. If you do, you'll see huge jumps. For example, when the if contract switches from 2403 to 2406, the price might jump from 3450 to 3650. That 200-point gap isn't market movement, it's a contract switch. To fix this, first, switch to the new main contract early. For instance, when the current contract's open interest is exceeded by the next contract by 1.1 times, switch the next day. This reduces jumps. But even then, small biases remain. So you need adjustment methods, such as adjusting based on the closing price difference before the switch, or the opening price difference on the switch day, or proportional adjustment. Different methods affect backtest results, but not adjusting at all is a recipe for disaster. Unadjusted returns show artificial gains or losses on switch days, making your backtest unreliable. For cross-sectional factors, you rank all commodities by the factor value at each time point, then compute the correlation between this ranking and the ranking of future returns. This correlation is the information coefficient, or IC. The absolute value of IC indicates predictive power. A positive IC means higher factor values lead to higher future returns. But IC is volatile, so you also compute ICR, which is the mean of IC divided by its standard deviation. A higher ICR means more stable predictive ability. Typically, an ICR above 0.2 is considered acceptable. This table shows an example of cross-sectional factor validation. The volatility factor has a mean IC of 0.029, an ICR of 0.29, and a long-short annualized return of 3.2%. The grouping performance shows a monotonic increase, meaning higher factor values lead to higher future returns. The basis factor and momentum factor behave similarly. The positioning change factor has a negative IC, with an ICR of 0.18, meaning smaller factor values lead to higher returns. The key is to look at the absolute ICR. Values around 0.29 and 0.28 are moderate. If ICR is below 0.2, the factor is weak. Remember, the goal is to find features that consistently differentiate commodity strength. For time series factors, you study a single commodity. You check if the factor value correlates with future returns over time. For example, for rebar, you might find that the 5-day change in inventory correlates with the 3-day future return. To validate, you use a rolling window IC. Take the past 120 days of factor values and the next 20 days of returns, compute an IC, then roll the window forward to get a time series of ICs. The higher the mean and the lower the standard deviation, the more effective the factor. This chart shows the performance of a time series factor across different window lengths, from 10 to 120 days. The blue line is the annualized return, and the orange line is the Sharpe ratio. When the window is too short, like 10 or 20 days, the signal is noisy, and returns and Sharpe are low. When the window is too long, above 100 days, the signal is too lagged, missing many trading opportunities. The optimal range is around 60 to 70 days, where the annualized return exceeds 13% and the Sharpe ratio reaches 1.6. This is the meaning of parameter optimization. You don't need to find the perfect parameter, but a robust range where performance is stable. If a factor only works at one parameter and collapses at another, it's likely overfit. The final step in time series validation is to look at grouped net value curves. Divide the factor values into 5 groups, from low to high, and plot each group's net value curve. If the factor is effective, the highest group, long, should trend upward, the lowest group, short, should trend downward, and the middle groups should fall in between. The long-short portfolio should be steadily upward with acceptable drawdown. This chart shows an effective factor. The blue line is the long group, growing from 100 in 2020 to 220 in 2025, with an annualized return over 15%. The red line is the short group, falling from 100 to 52, meaning shorting also makes money. The gray line is the middle group, flat. The clear separation and symmetry indicate strong discriminative power. If your grouped curves are messy, the factor needs rethinking. To sum up, we've covered feature classification, fundamental factors, data cleaning, and validation. The key takeaway is that framework beats factor, and system beats code. Most people start coding and running backtests, but they end up with noise. True professionals build a research framework first and then systematically search for factors. Remember to distinguish between cross-sectional and time series factors, clean your data rigorously, and validate with IC, ICIR, and layered backtests. Always look for robust parameter ranges, not a single optimal point. Overfitting is the biggest enemy. We'll see you in the next analysis. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.